Hello again, everybody. Doing here from DRFX Forex Swing Trading. Gonna be taking a look at the recent trade that was made on the Canadian Japanese yen, which unfortunately led to a trading loss of 120 pips. Now let's take a look at the daily chart. As you can see here, the market has reversed sharply and very aggressively to take out this bear candlestick signal that we had traded, taking out our stop loss and actually heading back above the outer uptrend line. Now, looking at the chart again and looking at the candlestick signal that we traded, you can see clearly that this is actually a large candle. I believe that when I looked at it when it was first formed, the way that I had my charts configured, it appeared as if it was a normal candle. So that was a justification that I had made, or that was a justification for taking the trade. But as you can see here, when I've reconfigured the chart to its proper state, you can clearly see that this is a large candle. And of course, when it comes to large candles, these are too risky to trade, and the market will either move sideways or reverse, as is the case here. So this was a mistake on my part in terms of identifying the candle to trade, and it's no surprise that since this is actually a large candle, that it led to a reversal that led to the trading loss. So that was a mistake on my part, and this should never have been traded. Now, what I'm going to do is, well, take a brief look at how we actually traded it on a 4-hour chart, and also identify how we could have actually traded it higher up using this normal candle um, earlier on in the breakout. Now, in terms of how we traded it using this pennant setup on the 4-hour chart, where we placed the stop loss above the resistance boundary of the pennant, with the hopes that the market was going to be continuing the breakout and head towards our 200 pip trading target. But as you can see here, the market had other ideas and started to reverse and took out this downtrend line, as it eventually led to the movement that took out our stop loss and rallied above the broken, back above this outer uptrend line. And as I said, this reversal is largely in part due to the fact that this is a large candle. Now, in terms of how we could have traded this at this candle here, when this candle appeared, it was confirming the start of the bearish move with a break below the support point, following on the break of this inner uptrend line and the false breakout that started at this area here. So now, when this candle appeared on the 5th of April, on the 4-hour chart, we actually did not have a very strong stop loss area in terms of a resistance boundary. But what you find is that when it comes to consolidation breakouts, because the movements are fast, it is very unlikely, or on rare occasions, that you're actually gonna find a market forming perfectly formed resistance or support points. So as you can see here, the market did not create any perfect resistance point until it broke up below this area here and formed this pennant setup. Because of that, because of the fact that we have defined these types of strong resistance points, such as this or this, when it comes to breakouts, once you can still draw a trend line across the highs of the candles that are formed, you can use that as a stop loss area. So when the market created that daily candlestick signal on the 5th of April, what we were seeing on the 4-hour chart would have been this bull candlestick signal, which was the last candle that formed as part of that daily candlestick signal. Now, in terms of the stop loss could have been placed at the 85.22 area above this downtrend line, and using a stop loss of 120 pips, since we would have been trading based on the signal on the daily chart, that 120 pip stop loss would have corresponded to an entry at 84, which, as you can see here, we would have been able to use as the market rallied following the close of that daily candlestick signal. So the market rallied, and we would have been taken in by an entry order that we would have used. Stop loss would have been placed at the 85.20 area. And entry would have been at the 84 area. Well, actually, let's use a higher stop loss of 85.30, which would have been a better, a more, well, would have been a better and a higher stop loss. So entry could have actually have been at 84.10 with 120 pip stop loss. So 84.10, targeting at a 200 pip gain at 82.10. As you can see here, this would have been hit at this area here shortly before the market actually started to reverse. Even if we had used a stop loss of 85.20, entry would have been at 84 on the dot. We still would have been able to get a 200 pip gain as the market also went through the 82 level. But this stop loss would have been better because it would have been higher at a better location above this downtrend line. So this 200 pip target could have been hit had we used that daily candlestick signal, which was a normal candle, and use the stop loss, use this trend line as a stop loss instead of actually waiting until we could see a perfectly formed resistance to draw the trend line. So that is one way in which we can trade breakouts, consolidation breakouts, by using trend lines that can be drawn simply above the highs of the candles that are formed, instead of waiting on a perfectly formed high such as this. So that would have allowed us to place a stop loss at this area, enter at this area here as the market pulled back, and then taking advantage of the market as it moved, continued bearish, where we would have been able to capture 200 pips. So this was a trading opportunity that was missed, which would have allowed us to avoid making this mistake of entering at a large candle and avoided this trading loss that we know that we experienced. So that was a mistake on my part. This should have been the one that we should have traded in the way that I just pointed out, and we'd have been able to avoid this altogether. So the lesson is, well, mostly for me, is in terms of properly displaying or properly identifying the candles, using these tools of using the zoom out and zoom in tools on the trading platform to get the candles in their correct size and form, so that we can properly identify the candles and the size of the candles, and avoid trading these candles, which, as you can see in the trading manual and in my videos, is a big no-no. Too risky to trade. So that was a mistake on my part because the charts were improperly drawn. So what we're gonna do, so what can take place now is, in fact, given the fact that this market has rallied sharply, another point to indicate is that it could be forming this pennant consolidation with this type of support instead of the one that we had drawn previously. So confirmation of this is going to come from a continued rally towards this area here, which will allow us to confirm that this is in fact a pennant setup instead of a range setup. So those are the lessons from this trading loss, an unfortunate loss, but we can use it to to make up for it with profitable trades.